Markets do not crash suddenly, they weaken quietly. Before the headlines scream, before retail notices, before social media explodes, money starts moving. And it does not move randomly, it moves with intent. When billionaires sense instability, they do not post about it. They reposition silently. You will not see a press conference. You will not see a warning. You will see subtle shifts, liquidity increasing, risk exposure shrinking, volatility hedges expanding. That is the elite exit strategy. It does not mean they sell everything. It means they adjust before panic. Most retail investors wait for confirmation. Confirmation comes late. By the time fear is visible, positioning is already done. Now look at what happens during early stress signals. Credit spreads widen, bond yields shift, dollar liquidity tightens. Corporate insiders sell small percentages quietly, nothing dramatic, nothing loud, but consistent. Billionaires rarely sell in one massive move. They scale out, they rotate, they create optionality. Optionality is power. Optionality means they can buy when others cannot. If you're fully invested with no liquidity, you have no options. If you are leveraged, you have even fewer options. Leverage destroys flexibility. Flexibility preserves wealth. When global risk rises, wealthy investors do three things first. They increase cash buffers, they reduce speculative exposure, they diversify jurisdictional risk. Jurisdictional risk is something retail rarely considers. Where is your money legally held? Under what regulatory structure? Under what political leadership? In what currency system? The wealthy think about these layers constantly. Retail thinks about price. The difference is structural. Now consider crypto specifically. When Bitcoin shows weakness, retail asks one question. Is this the dip to buy? Institutions ask a different question. Is liquidity tightening systemically? Because if liquidity contracts, all risk assets struggle. Bitcoin is a risk asset in liquidity contractions. This is not ideology. This is capital flow reality. When liquidity expands, Bitcoin thrives. When liquidity contracts, Bitcoin suffers. Billionaires monitor liquidity more than price. They monitor central bank balance sheets. They monitor interbank lending stress. They monitor sovereign debt risk. Retail monitors green and red candles. That mismatch creates transfer events. Now imagine a scenario. Global tensions rise. Political uncertainty increases. Debt levels strain. Markets feel unstable. The wealthy do not wait for confirmation. They quietly move portions of capital into short-duration instruments, into defensive assets, into hard assets, into foreign jurisdictions. They do not need full certainty. They need probability advantage. Retail waits for clarity. Clarity appears after damage. That delay is expensive. The elite exit strategy is not emotional. It is mathematical. Reduce downside exposure before panic. Preserve liquidity. Prepare to deploy when others are trapped. Well, you might think this sounds simple. It is simple, but it requires discipline. Most investors do not reduce exposure when markets are strong. They increase it because confidence is high. Confidence peaks near local tops. Fear peaks near local bottoms. The wealthy operate opposite emotional extremes. They trim during euphoria. They accumulate during despair. Now consider something deeper. When billionaires reduce exposure, they rarely go to zero. They rebalance. They hedge. They overlay protection, options, short positions, diversified allocations. They do not gamble on one narrative. Retail often does. All in on one asset, all in on one belief. That is fragility. Fragility breaks under stress. Strength bends and survives. Now ask yourself, if a major downturn began tomorrow, how much liquidity do you control? How diversified are you across asset classes? How diversified are you across systems? How quickly could you respond? Because during crashes, speed matters. Margin calls happen fast. Volatility spikes fast. Policy shifts happen fast. Those without flexibility get trapped. That is the hidden danger, not the crash itself, the inability to move during it. The elite exit strategy is not about running away. It is about positioning ahead of forced selling. Forced selling creates opportunity. Opportunity requires capital. Capital requires preparation. Preparation requires foresight. Retail often substitutes hope for foresight. Hope is not strategy. Liquidity is strategy. Structure is strategy. And that is where the real divide lives. We will go deeper. But first, understand this. When markets feel stable, that is when positioning begins. When headlines look calm, that is when adjustments start. By the time fear dominates the timeline, positioning is complete. The crash is not the beginning. It is the confirmation. And by confirmation, the advantage is already secured. When instability rises, the first visible crack is not price. It is capital migration. Money leaves quietly before markets collapse loudly. Large investors do not wait for crisis confirmation. They watch pressure points, sovereign debt stress, bank balance sheet exposure, currency volatility, geopolitical escalation. When those indicators flash yellow, capital begins to shift. Not dramatically, gradually. silent rotation. One of the first moves is geographic. Capital moves across borders. Funds reposition into jurisdictions perceived as safer, different legal frameworks, different tax regimes, different political stability. Retail rarely considers jurisdiction risk. The wealthy consider it constantly. If one country tightens controls, if one region introduces restrictions, if one government changes policy direction, capital needs escape routes. Those routes are established before crisis, not during it. Because during crisis, controls tighten, liquidity freezes, transfers slow, delays become barriers, preparation prevents entrapment. Now look at asset rotation. When volatility risk increases, exposure to high beta assets reduces. High beta means high volatility. Crypto, growth equities, speculative ventures. Exposure shrinks incrementally. Simultaneously, capital rotates into defensive positioning. Short duration bonds, treasury exposure, gold, energy, real assets tied to production. This does not mean full exit from risk. It means rebalancing risk. That distinction matters. Retail often thinks in extremes, all in, all out. The wealthy operate in gradients, gradual reduction, gradual rotation, gradual accumulation. Now consider gold. Gold does not generate excitement. Gold does not promise exponential gains. Gold promises stability during instability. When systemic fear increases, gold demand rises quietly, not because gold is glamorous, because gold is liquid and globally recognized. Billionaires use gold as insurance. Retail uses crypto as salvation. Insurance and salvation are different concepts. Insurance protects, salvation hopes. Hope collapses under pressure. Protection endures. Now consider insider behavior. Corporate insiders understand internal weakness before the public does. They see slowing revenue, rising costs, margin compression, supply strain, before earnings reflect it. When insiders sell consistently across sectors, it signals caution. Not panic, caution. That caution often precedes broader correction. Retail rarely tracks insider flow. Institutions monitor it constantly, because information asymmetry matters. Now combine these pieces: liquidity tightening, jurisdictional diversification, asset rotation, insider caution, gold accumulation, reduced leverage. These actions form a pattern of preparation. When markets eventually react, it appears sudden, but the preparation phase may have lasted months. By the time retail sees red candles, the wealthy have already reduced exposure. That is the structural timing gap. Now think about leverage. Leverage amplifies gains. Leverage amplifies losses. During expansion cycles, leverage feels powerful. During contraction cycles, leverage destroys. Billionaires rarely depend on leverage for survival. Retail often does. Margin accounts, high exposure, concentrated positions. During volatility spikes, forced liquidations begin. Prices drop further. Liquidations cascade. This is the liquidity trap. Retail gets trapped by leverage. Institutions buy distressed assets from forced sellers. That is not conspiracy, that is mechanism. Volatility transfers ownership. When markets fall sharply, the narrative becomes emotional. Blame politicians, blame regulation, blame manipulation. While emotion spreads, accumulation begins. Distressed assets trade below intrinsic value. Strong balance sheets expand, weak balance sheets collapse. The cycle repeats. Now bring Bitcoin back into focus. If Bitcoin falls sharply during macro stress, retail sees betrayal. Institutions see discount. But they do not rush blindly. They measure systemic stability first. Is this temporary contraction or structural shift? If temporary, accumulation begins gradually. If structural, exposure remains limited. This is risk management at scale. Risk management is invisible during bull markets. It becomes visible during crashes. Now consider political timing. Policy announcements can influence short-term sentiment. But wealthy capital does not rely on speeches. It relies on implementation, legislation, regulation, monetary stance, budget direction. When political uncertainty increases, capital demands flexibility. Flexibility means liquidity. Liquidity means power. The less liquidity you control, the more vulnerable you are. The more liquidity you control, the more opportunistic you become. This is the divide. The wealthy protect liquidity first. Retail protects belief first. Belief does not prevent drawdowns. Liquidity does. When the next major correction unfolds, headlines will focus on price. But the real story will be positioning. Who reduced risk early? Who preserved liquidity? Who avoided leverage? Who diversified jurisdiction? Who rotated assets gradually? And who ignored signals? The elite exit strategy is not dramatic. It is disciplined. It is layered. It is patient. It does not depend on prediction perfection. It depends on structural awareness. Now ask yourself honestly, are you positioned with flexibility or are you positioned with hope? Because the difference between those two determines who survives the next cycle intact. The greatest danger in markets is not volatility, it is delay. Delay between signal and action, delay between weakness and adjustment, delay between risk and response. By the time most investors recognize danger, positioning is already complete. By the time panic spreads, capital has already moved. By the time retail feels urgency, institutions feel prepared. That timing gap is where wealth concentrates. Now imagine the next true shock. Not a small dip, not routine volatility, a genuine liquidity event, a credit freeze, a systemic breakdown. When liquidity disappears, prices do not drift lower slowly. They collapse rapidly. During those moments, there are only two types of participants, those forced to sell and those ready to buy. There is no middle ground. If you are leveraged, you are forced. If you are illiquid, you are forced. If you are concentrated, you are forced. Force removes choice. And in markets, losing choice is losing power. Billionaires structure their capital so that force rarely applies to them. They hold cash reserves. They maintain diversified exposure. They avoid concentration risk that can destroy them. They assume instability as default. Retail assumes stability as default. That assumption is fragile. Now think about narrative control. During bull markets, optimism spreads quickly. During crashes, fear spreads even faster. Media amplifies fear because fear captures attention. Social platforms amplify fear because panic spreads engagement. But fear is not analysis. Fear is reaction. The wealthy separate emotion from structure. They analyze liquidity. They analyze debt exposure. They analyze capital flow. They measure probability instead of feeling pressure. When Bitcoin falls, retail feels personal threat. When Bitcoin falls, institutions calculate volatility metrics. That difference in internal response drives opposite external action. One freezes, one prepares, one reacts, one repositions. Now look beyond Bitcoin. Look at gold. Look at real estate. Look at energy. Look at sovereign bonds. The wealthy rarely make a single directional bet on the future. They distribute bets across multiple futures. If inflation rises, one asset benefits. If deflation hits, another stabilizes. If currency weakens, another hedge activates. This is structural resilience. Retail often seeks one answer, one asset to solve everything, one trade to change everything. That mindset creates vulnerability. Because when that one answer falters, confidence collapses. And confidence collapse triggers emotional selling. The elite exit strategy is not about running away from markets. It is about never being trapped by them, never being forced, never being illiquid, never being fully exposed to one outcome. This is what allows them to move first. When signals appear subtle, they adjust subtly. When signals intensify, they are already positioned. By the time retail sees confirmation, the window is closing. Now consider the psychological layer. Most investors do not lose because they lack intelligence. They lose because they lack structure. They do not plan for contraction. They do not plan for liquidity freeze. They do not plan for forced selling. They assume continuity. Markets reward preparation. They punish assumption. Right now, volatility is reminding everyone of this reality. Bitcoin weakness is not just price movement. It is exposure testing. It tests who is overextended. It tests who is concentrated. It tests who is operating without liquidity. And every cycle performs this test. Every cycle removes weak structure. Every cycle rewards disciplined positioning. The difference between reacting and preparing is subtle during calm periods. It becomes enormous during stress. The next major correction will not announce itself politely. It will accelerate. It will amplify. It will expose imbalance. And when that moment arrives, the question will not be what asset you believed in. The question will be how you were positioned. Positioning determines survival. Liquidity determines freedom. Structure determines longevity. If you want to understand how capital actually behaves during instability, if you want to study how powerful investors prepare before headlines change, if you want to move from emotional reaction to structural awareness, then stay close. Because this channel is not about hype. It is about decoding power. The next cycle will not wait for anyone, and those who understand structure will always move first. If this perspective sharpened your thinking, subscribe. Not for noise, for clarity. Because in unstable times, clarity is capital.